My name is Clayton Astles. I'm the Chief Executive Officer and Managing Director of Austco Healthcare. Thank you for taking the time to join us for the presentation with the Finance News Network. The company had a very strong year despite ongoing challenges related to the COVID-19 pandemic. Austco's positive results can be attributed in part to increasing demand for our products. Product development is a key component of our strategic plan, and we're maintaining our investment in R&D this financial year. We've developed high-value hardware and software solutions which are helping drive strong growth in our sales funnel. Our latest and most advanced product includes real-time locating, or RTLS, built into our hardware. This is the product that most of our customers are excited about and is responsible for much of the recent growth in our sales funnel and order book. With RTLS, we can record the location of staff, patients, and assets, and using that location data, our customers can correlate measurable metrics such as caregiver time at the bedside to patient outcomes. RTLS is expected to be a game changer for our business. As with most manufacturing businesses, we face challenges related to the global supply chain crisis, which has impacted our ability to secure the material needed to build our products. But it's not all negative. There have been some positive things to come out of the supply chain crisis for Austco. To mitigate some of the supply chain risk, we partnered with a third-party supplier who have the most advanced touchscreen-enabled IP phones on the market to develop a new master station for our Tessera product line. So really, the supply chain adversity gave us an opportunity to develop a solution that's far superior to what we had before the pandemic. Another product we've developed is a modern version of the hallway annunciator that we've manufactured for many years. With this new product, we have the ability to display non-Western characters, so simplified Chinese, and there's a lot of interest in translations of right-to-left languages like Hebrew and Arabic. So it opens up some doors for us as far as potential customers in regions where we don't have a large presence. This is great news. It's already secured a large order for this product, which is part of the recently announced 3.4 million KTPH contract in Singapore. Our goal is to design flexible and intuitive solutions that have a modern look and feel. Austco's App Station, for example, the new Master Station and the LCD Annunciator offer a lot of customization options and similar interfaces, which makes our systems easy to use for the end user. The product that's emerged as the key to the evolution of Nurse Call is mobile collaboration apps. Clinical care and communication apps are the combination of nurse call functions like managing alarms and alerts, as well as managing other systems alerts like telemetry, bed flow, and EMR. With advanced CC&C, it really doesn't matter which vendor's hardware generates the alarm. It's about collecting the data and doing something with it. And we continue to add features to our products that support the transition to CC&C. The industry's largest players are moving towards a total communications platform. Austco's product suite and roadmap reflect this. We start with the core traditional nurse call and built-in RTLS features. Austco's Tessera Pulse platform is a suite of software products designed to work seamlessly with our Tessera hardware. Pulse includes our primary alarm and notification software, including our master and touchscreen stations, workflow, and our advanced annunciation applications. Our clinical care and collaborative mobile app, Pulse Reports, is our enterprise reporting application. Pulse Manage is the interface on top of our APIs. It's a management suite for administrating our sites and an integration engine for additional integrations with other systems. We have a few opportunities to build out our portfolio. In some regions, remote patient monitoring is gaining ground quickly. This is a post-discharge monitoring in the patient's home. There's a large market for this type of solution, and this is an area of focus for Austco. With all of these pieces, we have a very good care communications platform, and this is the message we want to communicate to the industry. Austco makes software-driven hardware communication solutions, and the vision is that all of these components will share their data in real time, internally and externally with other systems. The data is the real product, not buttons or lights. The latest trend, especially for large acute care customers, is something called real-time health. And real-time health simply means that data from any other system can communicate with other systems. Healthcare providers use data from all of their systems to improve patient outcomes. So nurse call, telemetry, lab results, electronic health records are combined to help improve decision-making, automate workflows, and make communication more efficient. Our customers are especially interested in this location data from our real-time locating system. Supply chain challenges remain for our business, and they are expected to remain for the remainder of FY22 and possibly beyond. To mitigate the risks of supply chain interruptions, we have invested in additional inventory. Increases in raw material costs and additional freight costs will continue to test margins. However, this is partially offset by software and SMA revenues, as well as higher margin new hardware products such as RTLS-enabled call points. With a diversified contract manufacturer base currently located across 5 countries, we have de-risked country-specific supply issues. Now let's have a look at our strategic objectives. These are some of our key strategic objectives for FY22. Now that we've invested in developing high-value hardware and software solutions, and streamlined our operations by centralizing manufacturing, we're in a very strong position to drive revenue growth. In late 2019, we went to the market and raised capital to expand our sales and marketing capabilities. But with COVID, we had to put many of our recruitment plans on hold. As countries have started to open up, we've resumed recruiting salespeople. For the business to grow organically, we need to have more salespeople on the ground. And for us, the growth opportunities are in the US and Europe. So that's where we're focusing our recruitment efforts. Another way we plan to drive new sales is by adding resellers in new and existing markets. Typically, our resellers have their own salespeople who have relationships and connections in the healthcare industry, so it allows us to scale faster. We're also focusing on winning national accounts. National accounts are those that have multiple facilities spread across a geographical area. Another important element of our growth strategy is to explore acquisition opportunities that help drive exponential growth. We're looking at potential targets that complement our core business, including technology that fits into our product portfolio, and system integrators who can help us sell and install our solutions. A large part of the value in the solutions we sell lies in the software we've developed for enhanced workflows and improved patient outcomes. We have an opportunity to accelerate revenue growth by increasing sales of high-margin software and maintenance agreements. In the last 12 months, our sales funnel for software products has grown rapidly, so we really expect to see growth in software and SMA revenues in FY22. These are some of our operational strategies for FY22. As we mentioned, the company's gross margins have remained strong. Those margin improvements can be partially attributed to our strategic focus on operational improvements, including transitioning the business to contract manufacturing and distribution. We also want to build brand awareness in markets, and we plan to do that through partnerships with market-leading healthcare technology companies in strategic markets. And finally, we want to continue our focus on innovation. Over the last few years, we've released some great products that have been instrumental in the growth of our order book. The outlook for the company has never been better. Austco is positioned for growth well into the future. We have great products designed for the evolving healthcare market, and changes in technology requirements are going to come rapidly as countries invest more in healthcare after COVID. There's also a strong and growing global market for our solutions. We have a strategic plan to grow the business through investment in sales and marketing resources. While COVID uncertainties will likely be with us through 2022, those risks may be offset by our large order book, which I mentioned sits at 23 million. So the future of Austco Healthcare has never looked stronger. With that, let's start looking at our financial results. Despite the difficult market environment, the company generated 16 million in total revenue in the first half, which is up 15% on the prior corresponding period. Software and SMA revenues for the first half were 15.3% of total revenue. Margins increased to 52.9% for the half over the same period last year. EBIT climbed to 1.8 million, an impressive 65% increase, and NPAT was up 83% over the same period last year. Cash remained strong at $7.1 million, which was a slight drop since June 21 due to strategic inventory purchases that helped mitigate the supply chain crisis. As mentioned earlier, despite the difficult market environment, the company had a strong year and produced a 15% increase in total revenue over the prior comparative period due to improved sales and access restrictions to hospitals and aged care facilities being reduced. Installation revenues were up 55% on the prior corresponding period to $3.6 million, consistent with overall slightly fewer site access restrictions. Software and SMA revenues at 15% of total revenue for customers remained impacted by COVID-19 restrictions as high solution sales require face-to-face interactions, although they were up on the prior corresponding period. Once restrictions are eased, we expect to recover deferred revenues. Despite some of the challenges presented by COVID, the company has consistently grown its order book, which are confirmed orders that have not yet been delivered. Our order book currently sits at $23.3 million, and we expect much of that order book to be converted to revenue as COVID restrictions continue to be lifted around the world. Since the beginning of COVID, we have observed a material buildup in our confirmed orders. Strategic investments in inventory levels will allow these orders to be converted to revenues once access restrictions ease across our markets. Our recent investment in more sales resources in line with our organic growth ambitions will further add to the expected growth in revenues over the next few reporting periods, noting that our industry sales cycle is up to 18 months. Gross margin percent in the first half was 52.9%, which was slightly up on the prior corresponding period, but down from the second half of FY21. There have been a number of contributing factors. Supply chain cost increases have put some pricing pressure on our margins. A weaker Australian dollar over the reporting period. The revenue mix during the period impacted margins. Installation revenues, our lowest margin revenue stream, grew by 55% compared to the prior corresponding period. Software and SMA revenues increased to 15.3% of total revenues, and we continue to focus on growing this revenue stream, which will add further growth to our margins over time. The most significant risk for the company remains a global shortage of certain semiconductors, which has resulted in higher prices and historically long delivery timelines. To offset this, we have invested in higher inventory levels to ensure supply and to take advantage of the opportunities. Reported NPAT is $1.5 million for the first half compared to $800,000 for FY21. The second half NPAT of $2.6 million drove the full year result as we benefited from a rebound in revenues, particularly in the last quarter. Cash on hand remains strong at $7.1 million. The December 2019 capital raising proceeds have now started to be deployed. We've invested in strategic inventory and put on a number of new sales resources in North America and the Middle East to pursue our organic growth objectives. Some of the increases in inventory were strategic buys of raw material to ensure continued supply. The balance represents inventory held up by site access restrictions in some markets. The company has no effective debt, and our strong cash balances allows us to explore M&A opportunities. Thank you.